What is going on, everybody? Welcome on into today's stream here, Wednesday, May 31st, the final day of the month of May. We are looking at the S&P 500 as we speak right now, and we're going to be diving into what we're looking at right now, the overall setup, the overall market dynamics, some charts, a lot of charts, and then also I'm actually in the middle of switching some things out in the portfolio, which I think I'll touch on, probably a little bit in this weekend's video, but I'll definitely mention it now because I'm actively doing it. And so we'll talk about some of that because that was, it's where my mind's at right now. And I think it's useful stuff to at least talk about because there was some inefficiencies, I think, in the way that I was kind of managing hedges in the portfolio. And ideally, I'd like to manage them a bit differently and not have them kind of up in the air. And I'll explain what I mean by up in the air in a second. What's going on, Kevin? I was just down. It's funny. I was just down there. And, one thing about Florida that at least where I was the time, of course, I know with having a weather background, I went to school for all that stuff, how fast things can change. But here, it could be humid in the morning. We've had some days, the temperatures now at night get down to the upper 60s. Some days it'll be 70s. And you have this kind of humidness in the morning, but not that bad. Definitely Florida gets down to depends upon where, but coastal, you get down to 70 at night. And then it just is humid like a swamp almost. I found out the hard way by running 9 miles that one morning that I was there. Jeez, man, I came back soaked, just completely soaked and just I was probably exceptionally dehydrated. I probably lost 5 pounds of water on that one day off that one run. But that said, so here's SPY. It's down 0.5%, so we're getting a little bit of a pullback today. We still have weakness, relative weakness, that's for sure in IWM. So small caps down about 1%, a little over 1%. They were down more, closer to 2, closer to 1.5%, 2%. Here's the chart for IWM. I mean, I'm not really, until you get down below this box or lower end of this box, as of now, if the market's going to do what the market's doing now, I mean, this just looks like it's a better deal. I wouldn't buy any of these large cap techs. Absolutely not. If you're looking at I want to establish a new position in Apple. I mean, Apple's at all-time highs almost. So I wouldn't buy that stuff. So you're in better deals here, but at the same time, market goes down. This is where the weakness is at. So you would think, unless we get a shift underneath the surface, that you're going to see more pressure on this, and these will be the ones that dump the most, which then provides even bigger deals, right? If you look selectively in small cap land. So maybe it's not a bad thing, but if you are looking for deals, I mean, you want to look for, mid to small caps. It's just, you're not finding that in the super mega large caps right now. Selectively, maybe you can in other sectors outside of tech, but yeah. Retail, XRT down another 2.5% today. This is going to kind of start the discussion that I want to have on the shifting the portfolio, but that doesn't look good. I have a position here, and honestly, looking back, it's dumb. It's not it's not a well managed position in terms of the time horizon that I selected for it and the way that I'm playing it, and the spreads on the options. It's just kind of stupid, and I'll just talk about that in a second here. But let some people jump on in. If you guys wouldn't mind, hit the thumbs up button on the stream. That does help out. But in the rainy season right now, dry season's supposed to start October 15th, hurricane. Yeah, I mean, hurricane season is going to be in, we'll see how that goes this year, but it's always, interesting to watch from afar. Not that I necessarily have to deal with it, but my parents are looking at maybe, as they get older, they want to potentially get a place or maybe even move and potentially retire down in Florida. I think they're thinking more the Gulf coast side, which is it's great. That area is beautiful. The problem is that just you could get an absolutely devastating hurricane. And if you happen to be in the path, there's not much you can do. So you have to be pretty smart about your decision there. That's the biggest concern I have with that idea. And my mom loves it there, but I don't know. That's going to always be on my mind, at least if I was a homeowner, or if I was looking at something down there. But this is that time of year. It's definitely hot and humid. I wouldn't say it's insanely hot temperature wise. Here it gets hotter. You'll have 100+ degree days easily. But you can get humid, but you don't get as humid. Houston, if you go from Austin to Houston, different game. Houston, you can get the insane heat and humidity. That sucks. Here, it's not as bad humidity, but it can still get freaking hot. And that's just, that's just Central Texas for you in the summertime. But I don't mind it. I like the heat, so bring it on. I'm good. Okay. 10-year today is down again. This is what we're watching kind of close. Why? Because I think this is going to be, well, it's kind of just up at the top end of our channel. It's doing its thing, but it's rejecting off of that 3.85, 3.9-ish area. And if this continues to kind of fall off, I would have, potentially some thoughts or maybe some doubts on a hike into the next Fed meeting. This tends to move ahead of anticipation of the Fed. We saw this last push right here kind of came off the backs of, the idea of now, hey, maybe there's going to be more hikes, a couple more hikes. We thought a couple weeks back, a couple months back, we could potentially have paused at the last Fed meeting. Now we're like, okay, well, we'll probably pause at the June one. Well, now it's like, wait, we might actually probably not going to pause at the June meeting. Apparently, the current market projections are showing us that we are actually now at a 72% chance of a pause. So there we go. Now, that makes sense. So see this bar, how it popped up? These were like flip-flopped yesterday. And yeah, you can look. It was 66% chance of a 25 hike and 33% chance of nothing. Yesterday, now it's flipped and it's back to 72% chance of nothing and a 27% chance of a 25 hike from the Fed. So now you kind of going back and forth. But where was the signal like before this even flip happened? It was right here. It was in the 10-year was like a day or two ahead of that by putting in this relative top now. Who knows? It could be broken in the future, but put this relative high in and it's now pulling back somewhat substantially. And so that's telling you that's you can look at, like, depends upon what you like looking at. I personally like looking at the bond market, looking at the 10-year, just because I think it's a little bit ahead of the game and it's, a little bit of more of a signal versus everything else kind of follows. So you don't even need to look at this type of stuff. Like, who cares what the current projections are? It's pretty much going to be looking at the 10-year and it'll tell you. Now, the 10-year, of course, is 10 years out. Maybe you want to look at the 2-year. You can find the same thing. I mean, it's going to probably be the similar deal. Let me see if I can find the 2-year. I'm going to go to bonds. Here it is. Here's the 2-year bond yield. I mean, same general idea, past 2 days, 2 years pulled back decently. Nothing insane, but it went from, 4.6 down to 4.4, which is notable move. That's for sure. So we will see. But yeah, the idea that I was having was on XRT. What I originally did, let me see if I can pull it up, is I did this. So a couple days back, or like a week or two back, I forget exactly when, I went ahead and I bought a put debit spread on XRT. So essentially, if XRT, which is the retail ETF, is under $55 by the expiration of these contracts, they'll be worth a maximum of $5 in value, the difference between the high-end strike price and the low-end strike price. And we buy a put on the higher price or the higher strike, and we sell 2 puts on the lower strike. That's how it works. And I'm technically up on this like 7%. The max gain I could have on this is like, I don't know, 120-ish%, something like that. The problem is that the time horizon I put out was 2024. The reason why I don't love that is because when you're playing the debit spreads, like, you kind of want to wait these things out until that expiration date, because you could have a move down, which we are getting right now. From when I entered this, like, I entered this thing when we were like up around 60-ish. We moved down $3, which is on a percentage scale for XRT. That's like almost 5.5%, 6%. That's pretty big. But the options are essentially moving the same amount, which is not great. And I would have preferred this to move a little bit more if I'm going to play options on it. So had I just bought like $60 puts on XRT out to that time horizon, they'd be up a lot more. And we can probably find that. Like, let's go look at it and see. I'm sure I can find it. If I go in here, let's go to the Webull's chart. XRT options. Let me go find those January's 2024, January 19, 2024. And I go to like the $60 put options. You'll see, like, not that anything insane, but they went from, percentage-wise, a much better move. It's not a ton of volume on these, so you can't really tell exactly the date. But let's say you had something here. Let me go find the exact date that I, was at like $60. So that would be like right around the 22nd-ish. So let's see if I can find the 22nd on here. Yeah, it would put you like right into this range. So you're up like 16% on that from where that point would have been. Not like, nothing insane, but it's a little a better bang for your buck for that type of move. Whereas the debit spread, nothing wrong with the debit spread. It's just that you're not getting, like, you're looking at time decay, and as time moves on, the spreads and the option premiums and the pricing will eventually be, there'll be a difference of $5 as you get closer and closer to the expiration date, and that would be your max gain on the spread of this, which is the put debit spread. And so because it's so far out, this is not really moving that much, which is kind of not pissing me off, but it's kind of like, if you were going to hedge, dude, you should have just bought the far out puts and just said, that's the hedge. I'm buying January puts and that's my hedge. Like, that's, instead of playing the debit spread. It's a cheaper way to do it. That's why it's kind of like the cheap way to do it. The problem is you have to be, you got to have the time horizon or hold out for the time. If you're not willing to do that, or if you want to be a little more nimble when you get some nice gains and just take them, you can't really do that because your gains are going to be pretty small if that's what you're doing. So that's my only concern that I have on this. And I'm looking to get out of this, to be honest, to take, that 5 to 7%, even if it's maybe 10% if I get lucky, gain. And just, it was a week or two hold, and just, that's great in that period, right? Move on, but I'm looking to hedge in some other stuff, or just being more directionally based in the hedge versus having to be more time based in the hedge. And I don't want to be time based on the hedge because I don't know the time horizon. I don't know. Who knows? I'd much rather pick more of a directional move and buy like a leverage ETF or an inverse ETF, something like that, where you could essentially just hold on to that thing and not really have to worry too much about the timing. This is gonna happen or that, and that's really it. So that's the plan. And I think the ETF the ETF I've started to purchase in the portfolio is SRS. This is the ultra short real estate ETF. It's a 2X. So it's essentially, it's not as leveraged as your 3X DRV. So if I go to the real estate inverse ETF, DRV does well when here it is. DRV does well when the stock market or when the real estate market does not. And so you can kind of see the trajectory here, which has been, if you had held DRV, and you had potentially averaged into this and didn't just buy it all at once, or even if you did buy it all at once over the past year, there's a good chance you're up on your position, even though it's a 3X ETF, and there's decay here for sure. And the range has been pretty insane too. From lows to highs over the past year, you've had about a 200% range, which is nuts. So that's why there's a lot of volatility there. SRS, not as bad in terms of the volatility, so you can hold or stomach some of these bigger, stomach a longer hold. The move from low to high is about 100%, so a little bit less intense of a drawdown that you'd have to deal with. And my thought on this is, I bought in this portfolio, it's like $10,000, and I have some margin on there, so I'm probably in with like $12,000 of the in terms of what's on the line, but some of it's hedges, so I don't really mind or really care too much about the excess or having some margin. $1,000, the margin is free. The other $1,000 is like, I don't know, a few 7% per year or something like that, which is not that big of a deal because I'm not holding it the entire year on margin. But my thought is okay, you got some clear higher lows developing here, which makes sense. Real estate is just trending lower, and doesn't trend perfectly with the stock market, but it could. It has to do with rates and stuff. And so real estate's trending lower, which means this is going to trend, or this is trending higher. And if that trend continues, let's say we see a bigger hit to the real estate market, not to mention, we were just talking yesterday, was it yesterday, about the student loan stuff. That's going to be another big hit to the economy, to the consumer, to the average home buyer. That's an additional, payment on someone's plate, whether it's someone who is, getting out into the world and maybe just bought a house, or is looking to buy a house, well, now they're not, or it's potentially on people who are older who are paying for their kids, whatever. Now that's pressure on them. It's going to be more pressure overall in the economy. It's definitely a deflationary weight or pressure. And so that's why I think that this is a good hedge from a big picture macro perspective. That's why I like it. And, if the market goes down, generally speaking, this will go up. The last big time moves we just saw was essentially this February move. This thing came down hard because the S&P was pushing higher substantially. And then it bounced nicely here when the S&P pulled back for about a couple weeks, and then it's actually now holding up with a nice higher low. Does it have to hold that for me to stay in? No. This is not a technical play. It's a hedge play. But I wanted to get exposure to a real estate short ETF. And I was like, months back, I was like, I just don't know if it's time. It seems like it may, not seems like, who knows? It may be a bit early. Like this might take longer to play out. Now I feel like the time horizon in terms of until when we expect to see some bigger ripple effects in the market, like we're getting closer. Like for sure, either it's going to happen or it's not. So we're getting closer to that point. And that's why I think now the timing of it makes a little more sense. Is the price the best? No, you obviously could have got it much better a few months back, a much better price. But that's why I went with the 2x ETF instead of the 3x. I don't have to worry about the insane range. And I can get up to, 100 shares is about, $1,900, $2,000. You could try to sell covered calls. The option chain's not that liquid on SRS. So there's that, playing a factor into it. But it's not necessarily something I'm looking to cash flow off of or whatever. It technically has a slight dividend, but I'm just letting it do its thing. It's meant to be a hedge, and I'd rather hedge in something like this that I can sell essentially at any time and not have to worry about option spreads and time horizons and dates and all this shit. That's like, it just adds to the mess, and it makes it more complicated than it needs to be. I'd much prefer to be less complicated. Hence why we are looking to sell out of the XRT puts. I sold my oil puts today, which were gains. There were gains in that. I had MRO puts out to January of next year, had Oxy put debit spread out to that same time frame. And I think these are going to be potentially really good shorts, maybe even to look at again. But I just don't want to go with the debit spread idea. I much prefer the directional bet with buying plenty of time so that you can let it be a hedge instead of having it, be a time thing where it's like, if the move happens now faster than I thought, then great. I want to be able to take nice profits and move on versus having to wait. And then, you're tying up buying power and shit like that, which is not really a humongous deal because I'm not like super active in there, but I just want to simplify things down. So still like the shorts there, MRO and Oxy. I still think those could have some nice drawdowns from here. It certainly could be the case if oil stays weak. So we'll see. It's coming down to support levels though. That is for sure on MRO, and then on Oxy, very similar deal. I can get rid of this line. Similar area we're coming into. So we'll see if those levels hold, but you look at the volume profile, there ain't much for a decent ways down, which would be, potentially a freaking nutty short. Would take time to play out though, but that could be a nutty short, 6 months, a year from now, if oil stays this week. So here's oil's chart too, by the way. Looks like we had essentially just kind of like almost a bear flag set up yesterday or the past couple weeks. Not yesterday. The break happened yesterday. If you will, like you kind of had this higher low trend after a big move down and then flagging and then broke the flag. The thing that's funny though about this too is that you had the whole oil news and a few weeks back in like early April, which caused this gap up and everyone's like, oh shit, oil again, oil's back. What happened? That was an absolute bull trap. It just sucked people who were like, oh my God, I got to buy oil again, sucked them in, and now you're getting destroyed. Now it depends on what you bought. If you bought individual stocks, like you could probably be fine. Like if you went with ExxonMobil, yeah, you're getting crushed now, and ExxonMobil is finally unwinding a bit. But back at the time, ExxonMobil went to like all-time highs? Or yeah, I think it did, 119, 120. And then from there, it's down about $18 now. So decent move down on ExxonMobil. That just like was a sucker's move right there. People who got just sucked into that, and then they're getting, if you bought that may have been the last push on oil stocks. That move, if it for the short to medium term, when I say that, I mean months to maybe a year or two, you might be looking at weakness now on some of these things because oil has not been able to bounce back. And these stocks, a lot of these stocks have held up a lot better compared to other sectors and compared to oil's price action with how much that matters in their model. So that's what I'm gonna be keeping an eye on as well. Also, deflationary pressure for the for CPIs and for the economy in general as well. So something to keep your eyes on. Yesterday I entered into a CVNA trade, which is not looking great. It's coming back a little bit right now, but here's the thing. I bought June 16th, $15 strikes. And does this happen? Like this the thing about this setup is, and we were talking about this yesterday too, buying the June 16th, which was 2.5 weeks away, is perfect for this because you can even buy more. Because if you had played this, and many people did, but they're probably pretty quiet today. We'll see. I don't know. I'm not following. I don't give a shit about people on fucking Twitter about whatever they're talking about with whatever shit they got. Short squeeze my ass. Who cares? It doesn't fucking matter. It's a pattern to me. I don't care about the short freaking intra. It doesn't matter. Like, I'm looking at the chart and that's it. But we talk about this similar pattern that Carvana had, about a couple months back. And if you had bought this Friday's expiration calls, well, a day like today bends you over. You're done. Because now your contracts get obliterated if you didn't buy them prior to yesterday, or if you didn't buy them prior to yesterday morning. Your contracts get obliterated. And when you look at the chart, you're like, it still looks fine. It does. My stop loss is at like 1065. Like, I don't give a. That's where I would get out. Like, that would tell me if it hits this blue line right here. That tells me we had a break of this pattern, came back, false breakout. Okay, great. I'm out. Whatever. Who cares? That's it. But if you are holding this Friday where you only have like 2 days left until it expires, like, the pattern's still there. It's still fine. The setup in many people's eyes is probably fine, but you get screwed because you have to play for the 1,000% gain versus maybe the 100 or 200% gain if this happens in 2.5 weeks versus trying to time it to happen this week, right? So I think we'll see, how maybe my mind will change over time. But outside of a day trade perspective, where you are trading like 0-day expirations or short-term expirations because of the day trades, you're in and out. If you're going to swing trade, and that's what you'll see a lot of people kind of like, it's all marketing when you look at social media. Oh, look at my gains here. Look at me. I will stand behind the idea that is absolute bullshit, and it's not a sustainable model at all in terms of trading. It's really not. And there maybe is like the half of a percent of people that could maybe do it. The only way you can do it is your win rate, I can almost guarantee you, is going to be dog shit, but that's okay if you do have the ability to hit those 1,000%ers or whatever the number is, 500+% plays. If you can hit those with maybe a 25% win rate, yeah, you can be profitable. But it's not as easy, I think, as a lot of people think, because how many times do they expire worthless? A shit ton. They expire worthless. So that's just the concern. That's why this is fine. And yeah, it's down. Okay. Still broke out of the our pennant, our flag. If you want to call it a flag, you want to call it a pennant, you want to call it a triangle. I don't give a shit what you want to call it. You call it whatever. But essentially held the breakout over 12 and built a higher low for now. So, okay, let it do its thing. Breaks down. False breakout. Okay, it's wrong. So that's the deal on Carvana. Because we talked about that one yesterday. I entered that one yesterday. But yeah, that's what we're chilling at now. So the other thoughts were this SRS I'm going to add up to, or I'm going to look to get up to maybe 150 shares max. Even that could be a lot. It depends on how things play out over the coming weeks. And what I mean by that is, like, the portfolio is like technically like 10K right now. So do you want to go with more than $2,000? That's a good hedge. And if you ask me, 100 shares of this is about $2,000. Let's say I got 125 shares, a little over $2,000. That's a pretty damn good hedge. You know what I mean? So, like, if the market dumps off a cliff, not now, everything that I have is not all going to dump, because I have bond exposure, I have silver exposure. There's no guarantee that bonds and silver would also dump if the market were to dump. So you're kind of covered pretty well. That's why I don't need to have all these random option put debit spreads and stuff that I'm just waiting on and shit. To just play the simple game of like go get the shares and get some leverage on it and then just let it do its thing. That's the approach. And then sell covered calls. We sell covered calls and collect dividends, and then that's it. That's the portfolio. Which year to date, it's up 32%, which is nice. I will say that's pretty good. We'll see if we can keep that going. We'll see if we can keep it going, but it's not I'm not really super concerned about the day-to-day here. Like it's going to fluctuate. It's always going to fluctuate. It's more so where are the positions at? Are they in good spots to where you don't have a ton of risk, but you are positioned in case of certain things playing out. Back to the charts on the large caps. Let's see. XBI is up today. Yeah, here's SPY. Here's SPY's chart. I mean, you're putting in a doji candle right now, which really just means indecision. You had, wick up, wick down on the daily, and you're kind of right in the middle, which just says, I don't know. That's what it says. I don't know. I think we're kind of in this like weird dead zone period where like we may not really do much until there's something to kind of spark us. Maybe it's the debt limit talks. Maybe it's something else. Maybe it's some job report that we get tomorrow. Jobless claims. Manufacturing, PMI, ISM, construction. So there's some stuff coming out tomorrow on June 1st. Maybe it's also the end of the month. Maybe there's some beginning of the month. Who knows? But we're kind of at a point where it's like, like we don't really have a lot of stuff out until like we getting closer to mid-June. Then we got more catalysts to come. Go out an extra week beyond this week, and there's just not really a ton of stuff here as well. So it's going to be the week after the Friday, June 9th, that would be the next week, would be whatever what is like the 12th through the whatever. You have CPI and an FOMC. So those are two big ones right there. Maybe something else. There's probably more too, but that's the two big ones. So until then, you're kind of in this weird like dead zone, I want to say, where there's not a ton of catalysts outside of the debt limit talks, which, it's a big enough catalyst for sure. It just seems like the market hasn't really cared too much about that. I don't know. That's what it kind of seems like. What's going on, Kyle? Yeah, I was saying before, the plan is to start loading into, I got out of my oil positions today. Still think that they're fine. They're very valid ideas. The plan is to start loading into the SRS. I actually bought like a decent chunk of it today, but I'm not going to buy it all at once. I'll slowly buy more. It's not really going to be a covered call position. It's more so just like literally a hedge position. It's the 2x short real estate ETF. I don't want to go DRV and get the 3x. I think that's just a little too much for me right now for the appetite. I don't want to take on that much volatility. Could be good, but 2x is fine for the real estate sector. And then getting out of some of the put debit spreads, just because you got to wait like until the expiration for them to hit your max profit, even if you get the move. And so I'm just like, if I get a move that goes in my direction on a potential hedge play, I would like to just potentially like it's a hedge. I want to be able to take the gains from the hedge when I want to take the gains and then have that cash. Because again, a hedge is a hedge. It's not meant to, hit my max PT. Like there's no target realistically. There's a general idea that I'm looking at this to hedge my longs, but I'm not really looking at that as like, I need to hold this for 25% or more. And if I do that, then that's going to mean this, and this. No, if it makes money and I want to take the gains, I'm going to take the gains. And then I have that extra funds that I wouldn't have had if I didn't hedge. That's the whole point. Out walking, so let's listen. Okay, cool. So, yep, today was an interesting day. I had a Meta trade on. I had a trade on Meta. No, yeah, I did have Meta just recently. That was a loss because it was actually I had a green day today. I had an Apple trade first, but Meta I played this, which marginal break. It like kind of broke this level, which broke about like 20, not even 20 cents. 10, 15 cents. And then it fell back off. Probably could have cut my stop loss here, had my stop loss under these lows. So I could have had a stop a little bit tighter than what it was. But, I took that because the potential on this was like, hey, here's Meta's chart. If it gets above these highs, this setup we had later this afternoon, we break the high of the day, this thing could go 50, 60 cents, easily, maybe $1, easily. And then those contracts would pop. That's why I had the idea. But that was after, the only reason really I was taking that was because I was already green on Apple pretty nicely. And Apple, I played this. It was like fairly quick after the open. And it was the break over 178.25 or 24, whatever the number was. We essentially had Apple strong up near the highs of yesterday, within about like 75 cents of the highs of yesterday. Go out on the 1 hour chart, strong stock. I mean, thing's been a beast, right? So playing with the strength, absolutely not a short there in sight. So all I needed was it to present to me a 5-minute pattern that I could trade off of, and that's what it did. And you had this nice push off the open, and then you had essentially higher lows. Here are these higher wicks. 3 higher lows in a row. You broke on that third higher low. You broke out. I played on the initial break right here. And the contracts I had, which I bought for next week, ended up going 40-ish% to the top. I did not sell the top because no one can get the top with consistency because you don't know. You can say after the fact for sure, but on the way up, you don't know. So I sold the first one at around 10%, which was somewhere in here. And then I sold the last one around 35%, which ended up being somewhere up in here. And that was great because my risk on that trade based off the option contracts I was looking at for next week, because they're not as volatile as this Friday's expiration, which was down to these higher lows right here. So I took this breakout, and if it came back down and under those wicks, if those levels hit, I was going to stop out. So that was my stop loss, which equated to on the options around 5 to 6%. Which was pretty nice. And so you end up playing a play where you're risking 5 to 6 and you end up making 10, 15, 20, 35%, whatever the number was. That's pretty cool. So that's why I took that off. Looking back, could have had more contracts and maybe had a trailing stop loss, which the trailing stop loss would have hit somewhere up in there. But I ended up just taking the 2 contracts out for next week and sold them into that push. And that was really it. Just knowing my numbers too is kind of key. Knowing that, I'm risking 6% max roughly on this. So I'm seeing 10, 11% on the P&L or on the percentage on P&L. Okay, great. Let's lock a half of it in, knowing that that's a 2-to-1 risk reward right there. And then the next one could ride. And it went for a nice move. So that was it. DRN will be nice in rates. Fall ATR SMA. No, I've been trying a 9 EMA sometimes trailing stop loss, or it'll be under a recent 5-minute candle. So it'll be like, for example, like this push, this candle right here puts in its low right here. Like on the initial break, the stop loss is under the low of the breaking candle. And then we've got this second candle off the break. That higher low is the stop loss. So that would have equated to like this area right here, which would have been fine. We ended up technically hitting these higher lows later on here. So your stop loss would have been here. So every new candle that establishes itself, now we look back to the prior candle on the 5 minutes. So this is my thoughts on the 5-minute chart. And that low, the wick of that candle is where my stop is going to be if I'm going to do a trailing stop loss. Sometimes you look at like the 9 EMA, or the 10 EMA, you can look whatever you want. And that would have lined up kind of where VWAP was in this example. But it really, if it's not respecting that, I won't care. If it's respecting like, the 9 moving average, the 9 exponential moving average, the 9 EMA, then I'll take it into a consideration. If it's not respecting it, I don't give a shit about it. I'll just let it do its thing. But that's kind of the idea. So I'm getting better with that. But I think that comes at time. And seeing certain, it's more so, I think, a candlestick pattern execution on the stops. And, trying to use a signal. I really just, based off what I trade, knowing that I trade pretty much like a week-ish out expirations, like, okay, like it's Wednesday, I will probably just trade next Fridays unless I can't find a liquid contract for the stock I want to trade. So like, for example, I played Meta later on. So I had that trade there on Apple. And then I was like, okay, I'm willing to risk, at most half of the gains I made on Apple on this trade, max. This way I can still have a green day and but is it worth it? And I would have had a better trade risk reward if I had been able to find a contract that had a nice tight spread that was liquid out to next Friday for meta. I just couldn't find one that I liked in the price range that I kind of was looking for. So I played this week and I played with smaller size, but the downside ended up being like 15%. But that's, that's fine. I was with smaller size. So it's just 2 days till expiration. So yeah, you're going to have a little more volatile contract, especially if it pulls back against you. Could be more volatile to the upside, especially if it rips with your direction. But that's kind of my like thoughts on it all. But knowing I'm risking, 10-ish% on, my average plays, and I see 10 plus, we're starting to think about locking in gains, It doesn't really necessarily, like the chart's cool, but where we see 10 plus and we're looking at, okay, what are we gonna do here? Is it time to lock in gains? Is this move make sense? Is the risk reward still there? Like, what do we have left in terms of what was our risk? Were we looking to risk 15 cents or 30 cents or $1 on this trade? Now we're up, from our entry point, we're up $1.50. Okay, that's, really good. That's pretty good. Risk reward. Great. Let's lock something in. And, we also have the percentage on our side as well, knowing that we risked 10% on this trade or we're looking to risk 10%. And now we're up 15, we're up, 20%. Great. Let's lock this thing in. At least, a good chunk of it, and you can hold something for. The reality is that you can potentially miss out, and there will be 1 or 2 or even 3 a month, maybe more, that have massive outlier moves where it just trends all day. And if you took profits pretty quickly and proactively early on, you'll miss out on that huge move, which could be what makes up for, a ton of losses, or not a ton of losses, but could be what makes the month by having that trade that you entered in, and now the contracts are up 100% because it just kept going higher low after higher low after higher low, or lower high after lower high if you're playing the downside, and it just trended the entire day, respected, maybe the VWAP or maybe a moving average, or just it respected its own price action. Every, higher low was now a support, and it kept building, and it never kind of was wonky on you. You don't get those all the time, but when you do, you want to be there to take advantage. We're just not, today's not the day. Friday of last week, I think Thursday, Friday of last week, there were some days last week where you had that for sure, and I sold myself short because I took profits pretty proactively when we could have had, there was a Microsoft. Here's Microsoft. Like, I have the line still on the chart. I had Microsoft right here. I entered this right here, and I sold into this push. I could have had like double, even triple the percentage gains on the contracts that I was looking at if I just let it do its thing and didn't take gains, because it built this higher low, respected that, had this level right here, it just kind of stair-stepped up, right? And so not every day is most days are not like that. But when you get those days, you do want to have some skin in the game, that's for sure, because it could make a big difference at the end of the week, month, and then ultimately the year, right? Moving averages are mixed bag sometimes. Yeah, that's why it's not like a perfect, answer. It's more of like, if it's respecting it, I'll consider it more heavily. If it's not respecting it, then I'm not going to really care much about the 9 EMA or the 10 EMA, whatever the EMA is. Like, it is what it is. Checking on Kathy Wood, $40 there. Yeah, it's up again, under 1% there in ARK. ARK's doing pretty well past couple weeks. Been grinding from the mid 30s back up to 40. Not looking at I'm not gonna jump in on ARK just yet, but maybe we will get something growth related soon. The only thing is Soxel, SOXL, we actually, I sold a 21 covered call. It came back. I'm not surprised that it came back. I sold that for a decent premium, so I'm not like super pissed if it like ends up not taking me out. But we'll see. I have my plan on Soxel is I have 140 shares left of the position, and I'm going to be selling a covered call every month at least, maybe every couple weeks, and depends upon if they get taken out, if it gets taken out or not. And so if this one for June 16th, if it finishes over 21 and it gets taken out, great. I'll have now 40 shares left. But from here, every $5 is 10 shares get taken off. So 25 is my first or not my first target, my next level to take off, 10 shares, $30, 10 more shares, 35, 10, then we'll have 10 left. And at that point in time, hey, dude, like talk about a monster move. Like I will just take that. I'll be happy to take it off up in the 40 range, and we'll be completely out of that. It will take a lot of time, and we need a monstrous move in the markets for that to occur. But that's just what the plan would be. Could put it like a more of a trailing stop loss. If it falls back below, like, I don't know, 18, $17, just get rid of the last remaining shares. Maybe that's what I do, because I have an average at 10. So that's the plan. Trailing stop is really your last contracts. Yeah. Yep. Yeah, and that's the whole thing about the trailing stop. Like it's not like I'm holding my entire position for the while this, I'm getting out when my stop loss hits. No, because if you're playing a breakout or you're playing that's just my style, right? If you're playing a breakout or breakdown strategy, you're gonna get the max, like your juiciest percentage move or gain on the option contracts is going to be into those extensions. So like you break out, contracts should pop. And then if that pop, if you get a nice, 10, 15 minute push off the breakout, which tends to be a pretty reasonable, expectation to some degree, you want to start locking something in, especially if that move is substantial, as in you're looking at the chart and okay, like this, we've been holding here, consolidating here. We last big push on the candlesticks was 20, 30 cents. Let's say it was $1, whatever the number is, and then we break out, we pop $1 from where the breakout point was. It's unless your risk was like $2 of downside and it was like a really expensive stock. You get $1 move in your direction, you're probably gonna want to take something off, and that's generally what I'm doing. I'm taking off into that pop, and then if it wants to hold a higher low from there, great. I've already locked something in. I'm not gonna lose. And then if it wants to go for even a higher high, great. I'll take something off into that next higher high push. And then eventually, you'll have, a small piece of the position left. And that's kind of like that trailing stop. Once the pattern breaks down, it's more so it's the trend in the pattern. Once the trend and or the pattern break down and no longer are acting in the manner that would support continuation in your direction, that's where the trailing stop loss realistically comes in. Luke's listening while working out. Awesome. That's cool. I appreciate that. Yeah, I mean, the streams are, I really enjoy them. I mean, I think I was contemplating, eventually one day, like, I'm like, okay, like, what's the potential? Like, what's the future of that? Is it something you want to keep doing? Something that you want to stop? I don't want to stop doing it. I really don't. But we gotta figure out a way to make them a bit more enjoyable, I think. Because it's more so, like, in my view, it's more so just like raw. There's no reason to do a stream like people do and stuff and be like, oh, here are the top plays. Like, there's no fucking top plays. It's what we're looking at. It's what we're seeing. We're talking about stuff as it's happening, and it's more so I'll look back on the trades I have had today, if I had any, and today I had 2, which we covered a little bit ago, and the ideas and the things we could maybe improve on, I can improve on, or other stuff too that hopefully is helpful. But obviously, if there's stuff we're going to do live, I'll do it here. I mean, right now we're in the process of trying to sell out of our XRT put debit spread. I'm going to see if I can adjust this limit order really quick and just see if I can try to get out of this thing today. Let's see if I can get 2.3. It's going to be a small gain. It's just like, oh yeah, it filled. There it is. Okay, so we're out of that, just to give me some more buying power and also just to clean things up. Okay, so that's a pretty good spot. Now I'm looking at this and I'm saying, okay, what do I got now? We got about, let me just refresh. We're at like 10K in the portfolio. Just about 9997.85. And we got about $3,000 of buying power, roughly, which I think is good. It's fine. That's not a bad spot to be in. If I need to buy, I don't think there's a reason to do anything else here. Like this is good. I don't see anything to do. Like, let me get rid of this. For those who are watching, positions are on the bottom right. I have this Tesla was like a free fractional shares. I got like $10 worth of Tesla stock over the weekend for, I guess, someone hit my Robinhood link and signed up, which I don't even know if I have a Robinhood link anymore in the bottom of my videos. It must be from an old video or something, but that's kind of cool. Soxel, like we may be getting out of that soon. TMF is our leveraged TLT play. So we've got our recession protection there. So there's that. We're covered there. If it doesn't happen, oh, fine. You know, whatever. The other stuff may do well, and that will just fizzle out. And okay, great. Ideally, it's not going to zero, and we'll sell it before it goes to zero. Right? JEPI is the dividend play. We're getting close to the next month, which I believe we're going to have a recurring investment tomorrow of $50. I might up this number, by the way. I'm going to up this number right now. I'm going to edit that to 75 just because, fuck it, why not? Let's start being a little more serious about this thing. Let's go to $75 a month on the first of the month every month. And boom. It's funny, I have my my Chase bank account when I was in college. It was created, and so it says Chase College. The only thing that's annoying is I don't know how to change that. Like, obviously, I'm not in college anymore. I'm actually multiple years removed from college, but I don't know how to change that. I guess I could call Chase, but I just never thought to even really bother too much about it. So here you go. So now we're buying that $75 a month. That's going in tomorrow. So yeah. And we're just going to keep compounding this. That's now going to buy us, over almost like a share and a half. That's buying us about a share and a half of JEPI every single month, just to keep compounding and funneling money into this. And then on top of that, we're getting paid a dividend every single month, which is around, as of right now, I believe about a share. So that gets reinvested back in. So we're essentially right now reinvesting or buying through dividends and through additional investments about 2.5 shares a month on this, which the position is now worth $6,000. I don't really care. The total return doesn't really matter to me. It's a very diversified play, but it's the dividend income is more important to me. And so that's where we're at. So that's going to continue to keep going every month. We're up at 75. That's cool. Let that do its thing. But outside of that, we've got AGQ, which is, I'm back on the screen. I'm getting myself out the way. AGQ, which is our leveraged silver. I'm going to eventually move AGQ, swap that. So ideally, I would like to get taken out on a covered call that I sell and have it take me out. And then I'll be, okay, now I got to buy SLV. So AGQ, if it has a nice push, sell into that push, then sell a covered call into that, get taken out, then hopefully it'll pull back. There's no guarantees it pulls back, right? Or whatever. And then I buy SLV, which is not leveraged. So that gets me my silver exposure. It's a bit cheaper as well. It's in the low 20s. AGQ is in the upper 20s. And then there's still liquid options there. Every single week I can sell contracts or covered calls on that every week if I wanted to, or every month if I wanted to, whatever I want to do. It's up to me. So that's the plan. So I'm going to be looking at that. So I'm fine there. And then SRS is now this position is now about $1,400. And the more leverage, like right now, I probably should add, 25 shares to this thing. I could, and I may, but I'm just going to leave it at that for right now. But this, ideally I want to buy a pullback, or buy a dip, which if the market goes higher, then I can buy more of this at a lower price, which is the short real estate ETF. So it's our way of downside protection hedging. A weaker sector, market pulls back, that weaker sector, in theory, stays weak and maybe is a bigger downside play. And that's that. So that's where we're at. And, I think it's a pretty good spot. I got this Ethereum, like half a cent worth of Ethereum. I don't know how to get rid of it, man. I tried today. I bought like $10 worth of Ethereum, and then I tried to hit sell all, but it still keeps showing up that I have like 0.000000014 Ethereum. Like I just sell it all. It's just clogging up the feed. But that's it, man. And then I got these Carvana calls, which is like a minor swing play. There's only 3 of them, so it's nothing big. Talked about that one yesterday. And other than that, though, I think it's a good spot. I mean, I'm going to sell this Tesla once the shares become available, which they're not available to sell right now. It's just free stocks. So made 30 cents on it for my average. Cool, kind of cool. But yep. First few bars for the repeat is you get consolidation, second push, but that's more rare. Yeah, and that's the thing. Like on the breaks of a level, like, you know, you lock into that push. Some pushes are bigger than others. Like some breakouts will be bigger than others. Like for example, look at SOXL. Now, this is just on a daily chart, but like look at that break. That we had this level at like 1844. Look at that massive break. Now, hey, it may break up from 18, go to 25, pull back to 21, and then go back and then go up to 30 from there. It may. That doesn't look right. It may do this, right? It could do that. But, you know, if you are I would think somewhat smart, you know, you're doing something here to lock it in either, or selling a juicy covered call to protect your downside and also just to cash flow it. So that's what I did. Maybe it gets taken out, maybe it doesn't, but we'll see. Keep your feet and collect the interest until something good comes along. Exactly. I'm hooked on Jeppy. Yeah, I am. I am definitely hooked on it. Once we get to a point, maybe it's going to be, you know, in a perfect world, like what would happen in a perfect world. Now, of course, this is just me talking out of my ass. In a perfect world, we get this like we get this somewhat of a rally, right? Market goes, oh shit, we're going up. And then we get some big recession and the market goes, oh shit, we're going down. And we go down and maybe, you know, is it a new low? I don't know. But is it come down back under 400 on SPY? I think like in a decent way. Maybe it's 350, maybe it's 300. I don't know. We get something along those lines. Maybe it's more. And then like you can come in here, you know, in 2025 or 2024. I don't know when the time will be. Who the hell knows? Maybe it's 2025 and say, okay, you know, I now want to get more exposure to a bunch of sectors, to a bunch of stocks. We've been getting crushed the past couple of years. So we're in a recession. We're coming out of a recession. Market's bad. Big bear market for a while. Haven't had one of these in a while. I want to start buying, you know, a bunch of ETFs. I want to start getting exposure to just a bunch of sectors, you know, and I don't really give a shit about which ones it is. I just want to get general exposure because I want to capitalize. Even if I have to wait for a couple of years for the next bull market for whatever it is, you know, I want to start positioning myself for that because I've, you know, maybe capitalized in some way, or now I've got a couple bucks cash sitting around. I'm ready to buy, you know, some dips. And that's what I ideally want to be in the situation of. If that were to happen, that's in a perfect world. There's no guarantees like that would happen but like just being ready for something like that. If we did get the next leg down of this bear market, or if there is maybe, you know, a rally for a bit, or things kind of chill out for a bit and then we get a bigger leg down in a year, in 2 years, I don't know. Just not being dumb for that to happen. By no means am I going to sit here and be an idiot and start saying, oh, we're going to go down. The market's going to go down. And because there's a lot of people out there, man. There's a lot of people who are just who look like dumbasses. And if you ask me, who keep talking about, oh, this is it. This is the top. This is looking like the top. All my signals are telling me this is the top. Who fucking knows this is the top? Like, you don't know. No one knows if this is the top of this rally. I don't give a shit. All I know is that the market's been trending higher the past 6 to 8 months. And if you haven't been playing it, or if you've been on the sidelines, you're kind of like, oh shit, this sucks. And now you're like, oh, I definitely don't want to buy up here. But if it continues, which it's been doing, if it just keeps doing this same thing, you're going to kind of say to yourself at some point, well, did I miss the dip? Did I, you know, miscalculate? Like, who cares? Like, who cares about trying to time it like that? Because you're going to ask that question at the end of the day anyway. So there's no point of trying to guess. Like, that's why I think that there's a good balance. There's like two ways to look at it, right? There's the trading perspective and there's the investing perspective. If you're going to invest, don't fucking trade. Like, don't try to trade and time the market if you're just going to invest. If you're trying to time SPY, time the S&P, I mean, good luck. You might be right for a few months and be dialed in, and then you'll be wrong for 2 years and you'll lose everything. I've been there, done that, tried to think I can do that. I have no fucking idea what I'm doing when it comes to that. Really, I don't. So I stopped doing or trying to do that stuff because it's just not. And you live and learn by getting destroyed. And maybe that's a lot you'll have to do. And a lot of these accounts on social media that are like, you know, these super big time bears who are telling you all their metrics and all this shit, saying that we got to go down and all these things. Maybe they just need to get wiped clean to learn, and they'll end up being much better for it in the end. And I hope that's the case. But a lot of people get wiped out and then just sit there or not sit there, just quit and give up. And the market's going to always be here. So you're going to get plenty of bear markets, plenty of bull markets over the lifetime. That's all I know. So taking the things that you do know and using that to potentially put yourself in a position to capitalize in some sort of a sustainable manner is the end goal. JEPI and JEBQ is the way to be cautiously optimistic. I agree. Because like, hey, you're collecting that dividend, and if we get crushed, they'll get hit. Don't get me wrong, but you at least get that dividend along the way. Not much difference in dollar cost averaging and saving to buy the absolute lows because you lose dividends and compounding. Yeah. I mean, and you don't know when that's coming. You know what I mean? So that's why I much prefer, like, let's say you had a portfolio of $10,000, for example, or whatever the number is, and you were just all in SPY. Let's say you just bought SPY. You bought the S&P, said, hey, I just want to buy the S&P. I want to get exposure to a bunch of stocks, and that's it. Collect a dividend, cool, a little one, okay. It's 1.5% dividend on SPY. Okay, cool. But, I'm going to ride the market. I don't give a shit. I'm going to buy every month. My paycheck comes in every 2 weeks. So let's say I want to buy every 2 weeks. I'm going to buy $100, $50, $500, $1,000, 20,000, whatever the number is. Ideally, you get to that point where you're just tossing in super fat chunks of a change, and then that's just going to keep compounding faster, right? But whatever the number is, who cares? Use that portfolio. Do ultimately, right, run that dollar cost average strategy, and then when the market gets overextended or when you're nervous, you buy a freaking hedge. You buy a hedge. And so if the market gets crushed, who cares, right? You'll just buy more. Now you have even more. Like, you're just going to buy as you would anyway, unless you lost your job and whatever. Now that income stream dries up. So that's one, downside of a recession and why things can get really bad. Because when that happens, people are losing jobs. Now they got no money. They got to liquidate investments. You can see how things can get pretty nasty, right? So you don't want to be in that position. You want to have some sort of emergency fund, ideally, so you don't get yourself there. Worst case scenario, you just have to, pause your dollar cost averaging for, a few months, for maybe a year or two, because you're in a tough spot. Like in a perfect world, okay, then you can come back to it, no big deal. But you hedge, and then if you profit off the hedge, that money is now excess cash that you can now increase your additional dollar cost average investments, right? So that's the way I would kind of go about it. Save yourself the headache and dollar cost average. I agree. But the thing is, there's the allure of like, oh, well, I can make, much more than the S&P if I can time. Like, the S&P on average gets me 8% a year, whatever the number is, right? If I can time this, and maybe I can turn that into 16% per year. And now picture the compound effect of 16% per year, where I can compound that over my lifetime. I'll be a millionaire in, X number of years, right? Whatever. And it's like, sure, but what if you don't do 16? And how many people go from maybe having a year of doing 25%, maybe they did even better than that, to then in 3 years in a row of negative 25%, or at least negative 10%, negative 10%, negative, like, is that worth it to then have maybe these couple outlier years that, you got to kind of think about it for yourself. And I personally just say, hey, this dollar cost average approach is not a terrible idea. U.S. House of Representatives hold final vote in debt ceiling bill. Haven't seen anything come out from that yet, but apparently market reacted in a negative manner, you'd think, there. Off that news. JEPQ Devo. I like saying the name like that. SCHD, SPHD, all good funds, many, many more. That's a solid list right there. Was that 5? That's 5 stocks. That's a solid list of 5 right there. Yeah, eventually I'm going to get in. I'll get a second one on top of JEPI, just the side. Like, I think that's like the long-winded answer what I was saying before of like, if that were to occur, like if that market pull or that market move were to occur, obviously if we can cash flow enough and then build up a cash position and then maybe sell some hedges over time and then just have now the ability to say, okay, I want to buy 100 shares of like SCHD, whatever the number is. Great. But my thought was like, okay, I guess the market rallies up a bit, or let's say it sells off in a couple of years and, does something like, I don't know, like this. And now we're down in here. Like, that would be that time, or if we're lower, that could be that time that would make some sense to sell or to buy into that additional ETFs. So I got 2 of them, a little more diversified. Maybe one of them is more of a tech focus, one's not, or something along those lines to get better diversification. But essentially, those are the same thing. It's kind of the idea. So that's my thought process, right? Going out into the end of the year or into next year and whatnot. But for now, Jeppy is good enough, and we'll ride that train as long as she's going to keep on providing. So I don't see her stopping anytime soon. 11.45% dividend yield for the year. Pretty darn freaking good, if you ask me. What now we need is it to just have a nice rally, have some. So the good news about this too is that you're also getting better deals. Now this is kind of setting up in a wedge almost right now on Jeppy. Not that it really matters. I really care about this. No, I'm not trading off of this wedge, but you got this little wedge almost. Not almost. You pretty much do. You got a wedge. And so ideally, you break this wedge in one direction for a bigger move. So either it's going to be up, big move up, or big move down. Now, what you've got strong tech. Is tech leading the way, or is tech just kind of like inflating a bubble and we're eventually going to break down and have a bigger move down the markets? And is it going to do this? Yeah, that's possible. But let's say maybe there's this scenario where tech is leading the way, and then you've got a lot more, I don't know, I want to call them boomer stocks, if you want to call them boomer stocks, but you got these more safer stocks that are not leading the way that start to slowly catch up, and maybe tech slows down a bit in, the next couple of months or to, the middle of this year. That's what we kind of see. And then Jeppy kind of just does this nice kind of grinder and it gets back up, and we got a better, or closer valuation to where the tech stuff is and stuff. So the market's always kind of oscillating in cycles in terms of what's relatively strong and what's not. Right now, better deals though. You look at that. The other option was the JEPQ, which is more the tech focused. I mean, that's the example. Like that's the perfect example of like, this thing just broke to the upside and had a move out of this recent lower high. It moved like almost 10 or about 10% from that recent lower high break, but from relative low, this recent relative low, higher low here, it's up 15% on top of paying you about 12% per year in dividends. So that's pretty darn good, man. That's like almost 30% per year, or this past year if you had bought JEPQ about a year ago. No, not a year ago. My bad. What was that? A few months ago. Jeez, that's crazy. SCHD is probably what I'd pick right now, then JEPQ if QQ pulls back. Let's see what SCHD is looking like chart-wise. Yeah, that chart looks a lot, it doesn't, when I say it doesn't look good, I mean, in terms of like strength, who cares? Because I'm not buying this as strength. You dollar cost average into something like this. This is the Schwab US dividend ETF. Pays you almost 4%. Probably could sell some covered calls on it. It's $70. So for $7,000, you can get 100 shares. And, for $7,000, you go, oh, it's a lot of money for someone maybe who has a $10,000 account or whatever, or even less, or even maybe $25,000 account. It's kind of a lot, right? Percentage wise. Yeah, but you're buying diversification. You're not buying one, like you technically are buying one ETF, but you're getting pretty decent diversification inside of that one ETF. So it's not as bad of a diversified buy as you may think. For people who are like, oh, you gotta, diversify better. Well, maybe, yeah, you could. I mean, you could. But that seems fine. Much better deal too. Look how that's relatively weak. Much better deal on these stocks right now than tech. So hey, if you're looking at like, what do I buy? I got money, I gotta buy. What do I buy? And you're like, I don't know. And you want to buy something, but you're like more of like a longer horizon focused, investor. Don't buy tech right now. Buy shit like this. Buy like the Dow. Buy the Russell. Buy SCHD, right? Buy JEPI, because you got much better relative deals inside of there. And those stocks have been a lot weaker so far this year. Does that mean they're going to stay weaker? Who knows? But they've been a lot weaker so far this year compared to tech. So you're getting better deals. And eventually the rotation will come if we are in a bull market. Let's say we are. If we are in a bull market, like a new bull market for who knows how long it lasts. Is it a year? Is it 2? Is it none? Is it like, no, is it not? Is it just a bear market rally? I don't know. If we are though, what do you see inside these bull markets? One of the healthier signs, or one of the healthiest signs of bull markets, is when you see rotation. So tech gets going for a couple weeks, couple months. Then it's like, tech's not doing bad, but then all of a sudden, maybe, I don't know, this sector heats up and maybe this sector heats up, and you kind of oscillate back and forth between different sectors inside of that bull market. And it kind of sustains and one thing goes, consolidates for a while, pulls back a little bit. Then a couple months later, it goes again, and it just has this nice rotation. SCHD is quality enough to be a core holding if you wanted to. 100 companies. Yeah, 100 companies is a pretty good diversification, if you ask me. All right, so VIX, let's check out the VIX. VIX is sitting here at 1720. Try to get back over $20 past couple days, couldn't do it. The 10-year is back down to 3.64-ish. Projections now are that the Fed is now, or the probabilities lie, that the Fed is now going to pause. It's going back and forth. Yesterday, the thought was the Fed was going to hike 25. Now today, the Fed's pausing, based off the current projections. And I think we pretty much could tell that was coming because of the bond market, just, past couple of days and in yields, right? 70% chance now that we're going to see a pause, and a 30% chance roughly that we're going to see a 25 basis point hike at the next Fed meeting on June 14th. So with that said, that's going to wrap it up for the month of May. I hope you guys had a good month. I know for me, it was my best month metric-wise that I have ever had in day trading, ever. So I am pumped for that. Not going to ride it too high because, again, we know how that could change pretty fast. But I think this kind of sticking to the same pattern strategies and, what I've been doing this past month and just kind of take it to the next level, or just keep doing, not even really need to take it to the next level, just keep doing it. It's not about taking it to the next level. It's really just keep doing what you're doing. And we can, inside of that, there's tweaks that can be made to improve. And I think my biggest tweak that needs to be made, or that can be made going forward, is the scaling out of winners a little more effectively to capture bigger moves. Although, right, there's something to be said for, hey, if what your strategy has been doing now is working, like, who really cares? Like, yeah, you can optimize it. Sure. There's always that. And there's always, things you got to change, but who really cares? Because if it's working, just keep doing that. And all you would need to do over time is just slowly size up. And then you've got a printer almost, right? That's one approach or one thought process that I have as well. So we'll see how that goes, but no big tweaks seem to be made, no big adjustments. It's just going to be the general idea. The core of the strategy is the same. The core of everything, the core of the risk management is the same. Nothing's going to change in a big way. And it just becomes stack it up day after day, week after week. Now let's go month after month. So we got the day after day, we got the week after week, and now let's put together a couple months, right? At least, which has been the big hurdle in my own experiences, in my own trading. So with that said, I appreciate you guys. Hope you guys have a great rest of your afternoon on this fine Wednesday. I'll be back on a stream Friday afternoon. Hang out with us there if you want to for Power Hour, and I will see you guys in the next one. Peace out.